Rehabilitation, tangible.
If they have gross receipts of $10 million or more, then they're not allowed to take this safe harbor, even if they would otherwise qualify to take the safe harbor election. Always do. Just in case, you never know. You might be expensing something that's $2,500 or just a little bit less than that. And if the business gets audited later and the IRS says, oh, why didn't you depreciate this? Why did you expense this? This is an asset purchase. If it's anything that costs less than $2,500, for the most part, if it's an asset purchase or something like kind of a major expense, maybe you have, a rental property, because you can do this for rentals as well as businesses. Maybe you have a rental property owner and they replaced like the linoleum in the kitchen, or they replaced the carpet in one bedroom or something like that, and it costs just under this amount, the $2,500. As long as you check this box in order to make this election, then you're going to be fine. The IRS is not going to question it. But in order to take this safe harbor, if it's less than $2,500 for most businesses, in order to take this safe harbor election to expense those amounts, you have to make this election with a tax return. And this is what the election statement looks like. Other safe harbors. Now, there's also an additional safe harbor for real property. This is a small taxpayer safe harbor for real property. Taxpayers with gross receipts of $10 million or less can expense as repairs rather than capitalize as improvements amounts up to the lesser of $10,000 or 2% of the unadjusted basis of a building property, as long as the unadjusted basis is $1 million or less. And I'm going to give you an example of this, but I want you to understand that large businesses can't take this. It has to be a business that has gross receipts of $10 million or less. And it doesn't matter what their actual net income is. If they have gross receipts of $10 million or more, then they're not allowed to take this safe harbor, even if they would otherwise qualify under the other limits. Okay, so this is for small and mid-sized businesses only. Number two, if they're going to make this safe harbor, the basis of the building, the original cost basis of the building, has to be $1 million or less. If it's like a $5 million building or a $10 million building, then this is not going to work either. They're not going to qualify. The unadjusted basis of the property has to be $1 million or less. This is the basis without depreciation figured in. So basically, whatever you paid for the building initially when you bought it, it has to be $1 million or less in order to qualify for the safe harbor. Just like the other two, this is an annual election the taxpayer must make. Once made, the election is irrevocable. For whatever reason, if you want to change it, you can't do it afterwards. And the election is made annually. Example, Harbor Realty Inc. owns a strip mall. The business has an average gross receipts of $3 million. So this is the gross receipts for Harbor Realty. They're under that $10 million limit. So they're allowed to take this safe harbor for real property based on their size. The strip mall has an original basis of $400,000. This is what they paid for the strip mall originally. So it's also under that $1 million threshold for real property. So they're good so far, right? They're good so far. During the year, Harbor Realty replaces the carpets in the strip mall for a total cost of $6,000. This amount is less than the thresholds for the small taxpayer safe harbor for real property. Remember, the amount that they paid for the strip mall, the basis of the building, is $400,000. That's the unadjusted basis. This is what they paid for it originally when they bought it. Times 2% equals $8,000. So as you can see up here, the safe harbor has to be the lesser of $10,000 or 2% of the unadjusted basis of the building property. It has to be the lesser of these two thresholds. The cost of replacing the carpets was $6,000. That's what they spent. $400,000 is the unadjusted basis of the building. You multiply that by 2%, and that's $8,000. As long as they spent less than this on the repairs or the improvements or whatever they did during that year, they're allowed to expense the cost. So the carpet replacement would be deductible as an expense and does not have to be classified as an improvement. You don't have to depreciate it as long as it's under this amount, assuming that they qualify under all of these limits, right? So the business itself has to have gross receipts of $10 million or less. Then the building, or whatever type of real property it is, the unadjusted basis or the cost basis has to be $1 million or less in order to qualify. And then whatever they paid for in improvements or repairs or whatever it was had to be the lesser of either $10,000 or 2% of the unadjusted basis of the building. As long as the amounts were less than this, then they're allowed to take the small taxpayer safe harbor for real property and expense that cost in the current year. So under this rule, Harbor Realty can expense the cost of replacing these carpets. They don't have to capitalize it as an improvement. Okay, got all the dollar amounts here? Does that make sense? Okay. The next safe harbor is the routine maintenance safe harbor. And I'm going to explain this because this isn't really a dollar amount in this case. This allows for the deduction of routine maintenance costs that are required more than once within a 10-year period for buildings, or more than once within the applicable class life period for non-building properties. And I don't know very much about construction or building repair. I didn't go to school for that. So I asked another practitioner an example of this type of routine maintenance safe harbor. And he told me, he lives in a Gulf area, in the Gulf region. And they get pounded by hurricanes like every other year, it seems like. He said that the best example that he had was the replacement of a tar roof. So he had clients in Florida and Texas where the tar roof is technically supposed to last up to 20 years, but most of his clients that had, rentals in that area, if they had a tar roof or a gravel roof, they have to replace it every 5 years because there's always like a hurricane or a really bad storm that ruins it. So it has to be redone on kind of a regular basis, definitely more than every 10 years, because, a hurricane will come through or a really bad storm and it'll ruin it. So then it has to be replaced or at least, heavily repaired, let's say. So that in this case, he always will deduct it as an expense under this routine maintenance safe harbor because these people that are in the Gulf region, they have to replace their tar roofs or their gravel roofs, every 5 or 6 years generally. Definitely more than once within a 10-year period for their buildings. So in that case, you wouldn't have to depreciate it over time or capitalize it over time because it's being replaced more than once within a 10-year period. Okay, that's a routine maintenance safe harbor. Materials and supplies. Now this is everything else. And when you have materials and supplies, if they fall under these bullet points, then no statement is required. You don't have to attach anything to the tax return if it's something that will fall under these categories. Materials and supplies are classified as any unit of property that costs $200 or less. The IRS will just let you expense it. So for example, if you buy like a cheap printer, like a $50 printer or a $75 printer, one of those little cheap ones on Amazon, then you could just deduct that as an expense. Technically, it's an asset, right? An asset is anything that lasts more than 1 year. And sometimes taxpayers will want to capitalize these costs, even if they're small costs, if it's a small asset, because they want to be able to preserve those deductions for future years. For example, if they're in the 0% tax bracket this year or in the 10% tax bracket, but they know that their business is already becoming more profitable, they will want to capitalize asset purchases and depreciate those assets over time in order to preserve those deductions for a future year when their tax rate is going to be a lot higher. So that's just good tax planning. But you don't have to. You don't have to capitalize small asset purchases if the amounts are less than those safe harbors that we've discussed, or if it's any unit of property that costs $200 or less. You don't have to capitalize it. You can just expense it, even if it's an asset purchase, like a printer or a scanner or something like that. If it costs less than $200, you can just expense it. You don't have to track those at all. And you also don't have to attach a statement to the tax return in this case, if it's materials and supplies underneath these bullet points. If it's 12-month property, this is any unit of property that has a useful life of 12 months or less, and this is regardless of cost. So this could be something that costs $5,000 or even $10,000. If it's something that has a useful life of less than 12 months, then you can't depreciate it. It's by definition, it's an expense because an asset is something that has a useful life of more than 12 months. And if it doesn't last at least 12 months, then that's an expense, and that's regardless of cost. And I'm going to give you an example of that. Acquired components. This includes things like spare parts, air filters, or other components acquired to maintain or repair a unit of property. Incidental materials and supplies. These are items that are not part of inventory and used in a business and generally not tracked. This would be small items generally like pencils, paper, copy paper, staplers, toner, trash baskets, all that sort of thing. These are generally expensed as supplies. And any consumables. This is the cost of fuel, lubricants, water, and similar items that are reasonably expected to be consumed within 12 months or less, beginning when used in operations. These de minimis safe harbor elections do not include costs for the purchase of inventory or land. So if what you're actually purchasing is inventory for your store, for example, you can't expense that under these de minimis safe harbors. And then I don't know of any land that you can buy under any of these thresholds, but land is not included, and you can't deduct the cost of land if you're purchasing it under any of these safe harbors. Inventory and land, those can't be expensed under the de minimis safe harbor elections. And let me give you a few examples. High Grade Solutions Inc. is a manufacturing company. It uses an expensive type of industrial blade for cutting highly abrasive materials. Each custom blade costs $6,750. The blades have to be replaced frequently and normally wear out every 3 to 4 months. Even though the blades are expensive, they are deductible when consumed in the business because each blade's useful life is less than 1 year. So this is an expense by default. It's not going to be capitalized or depreciated because these blades don't last a year, regardless of the price. This amount, this $6,750, is above both of those safe harbors, but this is not an asset. These blades don't last even 12 months, so by definition, they're an expense. A statement does not need to be attached to the corporation's return, and the blades can be deducted as a normal business expense. These are not asset purchases, so they can't be depreciated because they wear out in less than 6 months. You wouldn't have to attach any kind of a safe harbor election or anything to the return. You just expense these amounts as a normal business expense. Example number 2. Summer Farms LLC owns 5 acres of pasture land that it rents to local farmers for a flat cash amount. Summer Farms pays to have barbed wire fence installed around the property. So this is a common type of land improvement. The barbed wire fence is a land improvement, which typically must be capitalized and depreciated. However, the owner of the fencing company is friends with the owner of the farm and gives the business a generous discount. The invoice for the entire job ends up being $2,475. So what safe harbor is this under? This is under safe harbor number 2. So this is just under the de minimis safe harbor. Summer Farms makes the election and deducts the entire cost of the fence as an expense on its business return. It has to attach that election that I showed you earlier, but as long as it does that, then it can take this entire amount as an expense, and it doesn't have to capitalize it and depreciate this land improvement over time because it's under that $2,500 for the de minimis safe harbor. Casualty and theft losses of business property. A casualty and theft loss of business property. A casualty is defined as the damage, destruction, or loss of property resulting from an identifiable event that is sudden, unexpected, or unusual. Theft may involve taking money or property by the following means: blackmail, burglary, embezzlement, larceny, and robbery. The taking of property must be illegal under state law where it happened, and it must have been done with criminal intent. With regards to businesses, casualty losses are fully deductible. Unlike individuals, it doesn't have to be in a FEMA disaster area. It's 100% deductible if it's a business loss, or for example, if it's a loss to investment property, like a rental, okay? Casualty losses are generally deductible in the tax year during which the casualty occurred. Theft losses can be deducted in the year which the business discovers the property was stolen. This means that, in the case of something like embezzlement, sometimes a business won't figure out that an employee or a bookkeeper or someone is embezzling from them, they won't figure it out for a year or two or even several years in a row. And then in that case, what ends up happening is the business can deduct the embezzlement or the theft in the year that the theft is actually discovered. That's how it's done. You don't have to go back and amend tax returns or anything like that. You deduct the theft in the year that the theft is discovered. Deductible losses related to business and income producing property, such as a rental, are reported on Form 4684, Casualties and Thefts. And if it's a large loss, I do suggest actually filling out this form, because this is a much less of an audit trigger than just taking the loss as an expense. And you want to do it right? So if it's a casualty or theft loss and it's a large loss, then you should always use this form, so that it's not an audit trigger like it would be just deducting it as an other expense on the tax return. Casualty losses are deductible up to the basis of the asset or the property that was stolen. If it was cash that was stolen, for example, from a robbery or embezzlement, then you would just deduct the amount of cash that was actually stolen. If the basis in the asset is zero, then the business will not be able to deduct a loss. Now, this is a big drawback, obviously. If you have a situation where a business has computers or something like that, and you've already taken the Section 179 deduction or bonus depreciation or other types of depreciation, and you've reduced the basis in those assets down to zero, and then those assets get stolen by a robber or someone else that comes in and just steals those items from the business. If the basis is zero, then you don't actually have a deductible loss. The IRS doesn't let you deduct losses where the basis of the asset is zero. So in that case, that's definitely a drawback. You can't deduct casualty and theft losses if you don't actually have a basis in the asset that was stolen. And let me give you a couple of examples. Andrew is a self-employed paralegal who usually works out of a small business office that he rents. A fire at Andrew's apartment complex destroys his couch, personal TV, and coffee table, which are his personal use property, for a total loss of $5,000. This is a personal casualty loss and is not deductible. The only way he would be able to deduct this loss is if this fire actually happened in a FEMA disaster area. So otherwise, it's a personal casualty loss and it's not deductible. The same fire, however, also damages a business asset, a laptop computer that he had brought home that day in order to catch up on his work. The computer is destroyed, resulting in a business casualty loss of $3,000 that is fully deductible on his Schedule C. So in this case, he had a basis in the computer, and he's able to take this as a deduction on his Schedule C as a casualty loss. Example number 2. Ben owns a shop that sells sports memorabilia. 2 years ago, Ben purchased a signed David Ortiz baseball jersey for display for $150 at an estate sale. So this is what he actually paid for the jersey at an estate sale, $150. The fair market value of the jersey was $2,800 just before it was stolen, and Ben did not have insurance to cover the loss. So the fair market value was actually $2,800. He had this like hanging up in his store. If he would have sold it, this is what he would have gotten from a buyer. But he actually only paid $150 for it. Ben's deductible theft loss is only $150, which is equal to his basis in the jersey. So he had a big loss here, but it was what we call a phantom loss. The fair market value is not what you can deduct. This is what he would have been able to sell the jersey for, but his actual loss is only $150, which is what he paid. And since he didn't have insurance to cover the loss, he doesn't get any reimbursement either. So the only amount of his deductible loss is $150, which is what he paid for the jersey. Insurance reimbursements. If a business has insurance coverage for property that is lost or damaged, it must file a claim for reimbursement, or it will not be able to deduct the loss. So this is a drawback here. I want you to understand the reasoning behind this. The IRS wants people who have insurance to actually file a claim. And if you don't file a claim, then you're not able to take the casualty loss. Sometimes people won't want to file a claim because they know that the insurance will either drop them or the insurance will go up. But if you have insurance and you don't file a claim, then you're not allowed to deduct a casualty loss. However, the portion of the loss that is not reimbursable by insurance, such as the deductible, is not subject to this rule. And I'm going to give you an example so you understand it. But the IRS's position is that if you have insurance, you better file a claim. Otherwise, you're not able to take a casualty loss for your business losses. If an insurance reimbursement is later denied, however, or is less than the taxpayer's expected recovery, the taxpayer can amend a prior year return in order to deduct a casualty loss that was not properly reported in the previous year. You're not supposed to actually take a casualty loss if you think your insurance is going to reimburse you. You're supposed to wait to see if the insurance will reimburse you. And then if the insurance doesn't reimburse you, or if the reimbursement is less than you expected, then you can amend your tax return in order to take the loss in that case. A casualty loss cannot be claimed if, during the year, there is a pending insurance claim, and it is expected that the insurance policy will fully recover the loss. But we know how insurance companies are, right? Many times they're going to deny your loss. You think that they're going to reimburse you, and then they end up not reimbursing you for the full amount, or what you thought they were going to reimburse you for. Examples. Cornelius and Marshall are partners and have a gourmet food truck that is used for business purposes. So this is like a little food truck business that they have. Cornelius has an automobile accident that causes $3,350 in damage to the truck. He and Marshall pay the repair bill out of pocket so their business insurance costs will not increase. So they had insurance, but they didn't want to file a claim. It's not a huge loss, right? They didn't want to file a claim because they knew that their insurance costs would go up if they did file a claim. The insurance policy, however, has a $1,500 deductible. Because the insurance would not cover the first $1,500 of the loss, this amount is their deductible casualty loss. The amount of their loss in excess of $1,500 is not deductible because they did not file an insurance claim. Kind of unfair, right? But this is how it is. Example number 2. Huntley owns a residential rental property. On November 20th, the property is flooded and the rental incurs $35,000 of damage. Huntley files his tax return on time. He does not report the casualty loss on his tax return because he expects to get fully reimbursed by his insurance company. The insurance company, however, later denies his claim because the policy did not cover flood damage. Huntley may amend his tax return using Form 1040X to claim the casualty loss on Schedule E. So this is a residential rental that had flood damage, and he thought his insurance was going to cover it, and they didn't. So in this case, he's allowed to amend his tax return in order to take the loss as a casualty loss because his insurance didn't reimburse him, and he thought that they were going to. Partial losses. Sometimes a business will have a partial loss. This occurs when a business property is only partially destroyed. In a partial destruction, the deductible loss is the decrease in fair market value of the property or the adjusted basis of the property, whichever is less. You can never exceed your basis in the property. You can never deduct more than your basis, basically. The amount is further reduced by the amount of any insurance reimbursement. Example, Cabernet Vineyards has a storage warehouse that was damaged by fire but not completely destroyed. The business carried no insurance on the property. The adjusted basis for depreciation of the building at the time of the fire was $65,000, and the fair market value at the time of the fire was $80,000. So the $65,000 was the basis of the building, assuming they had been depreciating it, and this was the remaining basis on the building. The fair market value at the time of the fire was $80,000. The value of the building after the fire was only $3,000, maybe just like the little sticks were left, like the frame. The value of the building after the fire was only $3,000. The business's deductible casualty loss is $62,000. The adjusted basis of $65,000 less the salvage value of $3,000. So they can never deduct more than their basis in the building or whatever property it is. That's it. We've reached the end. Next unit is Unit 8, where we cover depreciation.